This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet Microcap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet Microcap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. You can follow Planet Microcap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 201. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet Microcap on iTunes. It really helps provide feedback for me and spread the microcap message. Today's episode is sponsored by Quarter, whose mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. Visit your app store of choice to try it out, and that's Quarter, Quartr. We are less than 3 weeks away from the SNN Network Canada virtual event happening December 7th through 9th, 2021. Please go to canada.snn.network to see the list of issuers that will be joining us. Paul Andriola on behalf of Small Cap Discoveries and myself on behalf of SNN Network are teaming up to highlight our neighbors to the north, Canada. Paul and his team have been finding value accretive opportunities on the TSX, TSX Venture, CSE, and now the NEO for a long time. And as a result, we wanted to host an event that encapsulates those opportunities. So you can expect 3 days of keynotes, educational panels, company presentations, and one-on-one meetings. To register, please go to canada.snn.network and click the register button. We look forward to seeing you all there. For episode 201 of the Planet Microcap Podcast, I spoke with Rich Howe. He is the founder and editor of Stock Spinoff Investing, a premium newsletter focused on spinoffs. I originally met Rich when he was a guest on Avoiding the Crowd with Maj Soueidan, a great episode, by the way. I highly recommend you guys all go and listen to that. And it inspired me to not only start following Rich in his newsletter, but I want to share more of his expertise on here. As you can imagine, our conversation is about all things spinoffs, criteria, identifying opportunities, case studies, why they go unnoticed by most investors, and much more. Thank you again for tuning in to episode 201 of the Planet Microcap Podcast. And please enjoy my conversation with Rich Howe. Welcome back, everybody, to the Planet Microcap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today, my guest is Rich Howe. He is the founder and editor of StockSpinoffInvesting.com. It's a premium newsletter covering all things stock spinoffs. I'm really excited to have him on today because I love special situations. I think spinoffs are just so interesting. There's such great stories within there. So much just everything involved. I originally met Rich when he was a guest on Avoiding the Crowd podcast with Maj Soueidan, and I've been a follower ever since. So with that, Rich, thank you so much for joining me today. How you doing, man?
Good, man. Yeah, I've been a big fan of yours. Been listening to your Microcap podcast. I think I've listened to most of the episodes, so it's fun to be on here. Yeah, really happy to be here.
You know, I'm glad you said that because there's a quiz at the end of this. So I hope you're ready to, we just published episode 200. You're 201. So this is around quiz time.
I like it. All right. We'll see how I do.
We'll see how you do. All right. Well, look, as I said at the open here, we're going to be doing a full deep dive on spinoffs and why this is such an interesting special situation. But before we get into all of that, where did your passion for investing begin? What was it that led you to your focus being on spinoffs?
Yeah, so a great question. So I both my parents were in the industry. So my dad was a large cap value portfolio manager in Boston at a relatively small partnership. I think they had like $1 billion under management, and my mom was a bond analyst for PIMCO. So they were both kind of in the industry. I just kind of gravitated towards stocks, so my dad was a good teacher. I could kind of ask him, a million questions. From there, I joined kind of the investment clubs and in high school and college, did that whole thing. And, just loved investing, thought I would, eventually one day kind of be a portfolio manager. And yeah, so it was kind of like, I just loved it. It's one of those things that I've, just liked. I kind of knew that I wanted to be in the markets from I guess, a pretty young age.
Very cool. So, I mean, what was it then? Catch me up. All right. So you've always been in the markets. Your parents were in it. So you clearly at the dinner table, we're talking a lot about stocks and investing. So, I mean, how did you get to spinoffs? Like what was
totally.
there an experience?
Yeah. You asked that question and I just completely ignored it. So, good question. My mom's bonds, my dad's value stocks. How do I get to spinoff? So I started my career at Eaton Vance, which is a large cap equity management firm, mainly picking large cap stocks. So great place to start my career and learned a ton. Like many, I read, You Can Be a Stock Market Genius, one of, I think, Joel Greenblatt's first book. And like many, it just kind of like hit me like a light bulb. The chapter on spinoffs, I think, is like 60 or 70 pages. And it just made so much sense. And I'm sure we'll dive into it, but historically they'd outperformed. So that was kind of interesting. There's a lot of non-economic reasons why, there's a lot of indiscriminate selling, typically when a spinoff first starts trading. And so it just seemed fascinating to me. I obviously wasn't the first or the only person to read that book, but that's when I got kind of really interested in diving deep into spinoffs. And that's when I started kind of first investing in, trying to, make money investing in spinoffs. That was probably around, I started working in 2006, probably around 2007 or 2008.
Very good. So okay. So catch us up because we're going to get into all the definitions and where to look and all that stuff very soon. But then, so catch us up from that 2006, 2007 range to today. What did you do in your career? And then what led to then ultimately you starting the newsletter, Stock Spinoff Investing?
Yeah, so I started my career at Eaton Vance, the large cap equity research shop. I think Morgan Stanley recently acquired them, but did the CFA program, stayed there for about 7 years. Long only manager, assets under management weren't growing that well, so there wasn't as much upward mobility there. So I looked around for some other options. I ended up switching gears and started working at Citi Private Bank in the private equity research group. And that was kind of completely different from what I was doing at Eaton Vance. Basically, we were trying to evaluate private equity managers. So it was kind of like an allocator role where we meet with, the best and brightest of the private equity, private real estate world, see who's doing interesting things, and then try to set up a separately managed account for Citi Private Bank clients to invest into. So I was there for 5 years, awesome experience, learned a ton, learned the private equity business. But, I always wanted to do something entrepreneurial. And I thought I'm going to start a fund at some point or something like that. But I read this book, and I don't know if you've read it, called The 4-Hour Workweek by Tim Ferriss. Yeah, I'm seeing if I can spot it behind you.
Yeah, no, I got it. Yeah, there we
got
go.
It down there. So that book was really eye-opening for me. It kind of opened up my eyes to people who were building businesses without taking on venture capital money, like basically kind of information-based businesses, whether it's a newsletter business or some other, consulting type business. I always thought if you start a business, you got to have a lot of money and raise venture money, and you got to be trying to start the next Google or Facebook. But this kind of opened my eyes into, newsletter businesses and things like that. And I thought, what would I like to do? What do I love doing? Like, what am I naturally drawn to? And, what am I, good at? What are the things that I'm good at? And one of the things that I discovered, or that it was a hypothesis. Well, I love investing in spinoffs. Let's start a blog. So I actually did that anonymously. Hopefully Citi's not listening. While I was at Citi, built up a following, had some good stock picks, and I wanted to basically kind of turn it into a newsletter and see if I could do it. So this was in 2018. I was married, had one kid. My wife was pregnant. I was the only one working, but we had saved up a good amount of money, and I convinced my wife to basically let me, take a shot and try to build this newsletter business. And so, I started my blog, Stock Spinoff Investing, in 2016, turned it into a newsletter in 2018. And then for the past 3.5 years, I've been, working at it at the Stock Spinoff Investing newsletter, trying to get better and trying to kind of make my service better and better.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter. And that's Quartr. Now back to the show. Very cool. All right. Well, then let's dig right in. I think we're there. What are stock spinoffs? For those who, for those who are listening in because they know us, they know Rich, they've been following him for years. We apologize if we're going through some Investopedia 101 things right now. But for those who haven't heard of spinoffs and everything about it, what exactly are spinoffs, and then why are they interesting investment opportunities?
Yeah. So basically, what is a spinoff? A spinoff is when a public company spins off a division into an independent public company. So a good example is a recent example is there's a UK UK insurance company called Prudential. They recently spun off their annuity business called Jackson Financial to shareholders. So if on the beginning of September, before the spinoff, you were a shareholder of say you own 40 shares of Prudential PLC, today you own, unless you sold anything, you own 40 shares of Prudential, and you also own 1 share of Jackson Financial. So it's basically splitting up a company into more than one separately publicly traded companies. And then why are they interesting? So they're interesting for a variety of reasons. First of all, historically, they've outperformed. So, generally, when Joel Greenblatt wrote his book, I think he said that the average spinoff has generated about a 20%, annual return versus the S&P at about 10%. So that's per year. So some pretty, dramatic outperformance. Like I said before, I was the only one that read the book. So there's been more and more interest in spinoffs. And I think, it's a little cyclical. A lot of people are interested in spinoffs. And so the returns might go down a little bit. But my experience is that they're still outperforming to this day. So why are they interesting? Number one, because they tend to outperform. Number two, they're interesting because there's often indiscriminate selling. So basically, when you're buying a stock, you're going to be confident that basically somebody is on the other side of the transaction and they're selling their share to you, and they believe that it's a good idea to sell the stock to whoever's buying it. They don't know you're buying it, but they clearly think it's a good idea to sell the stock to you. In spinoffs, oftentimes people will sell spinoffs for no reason whatsoever. Just to give you an example, to go back to Jackson Financial, and I'm actually a shareholder of that. I wanted to disclose that. But if you're a Prudential shareholder and you own 40 shares of 40 shares of Prudential, and then all of a sudden, the next day you look in your account and you have one little share of a company called Jackson Financial that's apparently an annuity company, and it's a tiny odd lot position for you, and you know nothing about it. It's not going to make a difference. One share in your portfolio, you're either going to have to do some work and make it a real position, or just sell it because it's like, I got plenty of stuff to do. I don't really want to spend time on this. And so more often than not, people will just sell the spinoffs, especially the small ones. And so there will be waves of indiscriminate selling pressure. Oftentimes, index funds will own the parent company and they can't own the spinoff because the spinoff isn't in the index. Oftentimes, portfolio managers are focused on large cap stocks. If a large cap stock spins off a small cap stock, their mandate prevents them from owning the spinoff. So if you do your work ahead of time, and you can, because these documents that are called Form 10s are filed, which basically show the pro forma financial results for the spinoff. It's kind of like an S1 if you were to think of an IPO. You can do the math, figure out who the comps are, do your valuation analysis and figure out what a fair price is. And then, if the stock comes out, it gets sold indiscriminately and it's selling at a 50% discount to your, fair value, then that might be pretty interesting. So that's kind of why I find them so interesting.
Very good. All right. So we're going to take another step back, because I think some people might be asking themselves, including myself sometimes when I see a spinoff happening, is would a company want to spin off something within their own business? Like where's the incentive there?
Yeah. So essentially, basically it's all around simplicity. So Wall Street, and it's one of the reasons why microcaps are so fun, I think, is that they're really easy to they're really easy to analyze, because it's usually just one business line and exactly what they do. You can find comps that are directly comparable to, hopefully their business. And so it's really easy to evaluate and really easy to analyze. When you have a conglomerate, oftentimes there will be a conglomerate discount just because, this business is worth this business is worth this, but you're not really going to pay full value. And so oftentimes there will be what's called a conglomerate discount, because it's just hard to really know too many details about all the different businesses under the hood of some of these large conglomerates. And in general, just Wall Street prefers simplicity. It's just easier to analyze, easier to value. And so generally the case is that if you do spin off these different businesses, it will increase your value, because each individual business would be valued higher than if they were just jammed together. And then other times that spinoffs take place, I'll give you another example. Anglo American, it was a big mining and metals company, and it spun off a company called Thungela Resources, which was focused just on coal. And the reason it spun off that is because from an ESG perspective, coal obviously is not very attractive. And it was such a small part of their business that it's much easier to just spin that off and not have to worry about it, not have to worry about the ESG headlines, than have to have that in your business line. So there's a lot of reasons why companies could create or move forward with the spinoff, but the biggest, the most compelling one is just to create certainty and clarification over what each individual company does.
Very good. Yeah, because so often, sometimes, especially as these companies get bigger and bigger, there's more and more lines of business. Maybe there were some pocket acquisitions that ended up getting a lot bigger than they thought, and those were private businesses, and now they can spin them out, because you brought up an interesting point there too, when it comes to, especially when you're looking at the mining industry and some of these other tech conglomerates too, is that there's sometimes a lot of narrative plays here, right? Especially in tech and in other things as well. So 100%. that can have a lot of I guess play, so to speak.
No, totally. I completely agree. Just to give you another example that I just thought of. So there's a company called Vector Group, which is a small cap company. I think it's under $1 billion. But I need to do more work on it. It's already moved up a bunch, but they announced that they're doing a spinoff because they have basically a real estate brokerage business, Douglas Elliman. And then their other business is a tobacco, their tobacco manufacturing company. So nothing to do with one another whatsoever. And then on top of that, there's a lot of funds and indexes that aren't going to own a tobacco manufacturer due to ESG concerns. So there's 100%. A lot of things come down to narrative, and it's not just about the numbers, but it's like, hey, if I do XYZ, maybe I'll be eligible for more shareholders to own my stock.
And Rich, is there a big enough universe of spinoffs out there? I want to make sure you're busy. I don't want you to just be bored because there's only 2 in the last 6 months. So can you give us some perspective there?
Yeah, of course. Yeah. So there's about, I call it, 20, roughly in the US, there are about 20 new spinoffs per year. So that definitely keeps me busy. Just in the last week, there were 4 new spinoff announcements. But also there's a lot of spin-off announcements that haven't taken place. And so you do your work ahead of time. Sometimes it makes sense to buy the stock ahead of the breakup. There's just a lot of different ways that you can play these situations. For instance, you can wait for the spinoff to take place and try to buy a stock that's been indiscriminately sold that you think's worth a lot more. You can buy the parent company right ahead of the spinoff event and basically hopefully benefit from that valuation unlock. Like GlaxoSmithKline is a good example of that, where they announced the spinoff like 3 years ago of their consumer division. And so it's like, I look at that, add to my watch list, but it's like there's nothing to do until the spinoff approaches, but we're getting close to it, and it looks like that event is actually going to unlock some value. And so so there's a lot to do. And then also, I'm trying to recommend stocks that I think are super compelling. So it doesn't have to be a spinoff. So it'll be really any special situation. One area of the market that I've focused on recently is like companies that are selling divisions and then paying out special dividends. I've just found that the market, for whatever reason, even though it's publicly disclosed, like doesn't fully appreciate the special dividends that have already been hinted at but haven't been formally announced. I don't know what it is. I don't know if, once the dividend becomes officially declared, the algorithms come in and bid up the stock. But there's a lot of like different kind of interesting things going on in the world. And then, as you know, I also look at microcaps too. So there's definitely plenty to keep me busy.
That's for sure. But so now we're going to start to get into like the identification of finding these spins. Obviously, it's easy. I don't want to say it's relatively easy to find them when it's finally been announced, but let's go on the more nuanced art of spinoff investing. And that's trying to identify potential ones that may come up. What are some of the things that you look for when you're evaluating maybe companies that might sell off a division or might spin off that division or something like that?
Yeah, totally. So one thing that I do, and this is totally basic, anybody can do it, but basically I use Google Alerts. So I have a bunch of Google Alerts that, if you reach out to me, I can share with you, but it's nothing crazy. It's like spin-off business, special dividend, because oftentimes spinoffs are categorized as shareholder dividends or special dividends. So oftentimes you can get a hint. For instance, the word spinoff will be flagged in a transcript, but the spinoff transaction actually won't be announced yet. And so, that's a case where you can kind of, get a little bit of kind of inside information or kind of maybe appreciate the information a little bit before the transaction is officially announced. But honestly, Bobby, you don't need to predict. You don't need to predict them. There's so much opportunity just following the ones that have been announced, because I'll give you an example. So IAC, IAC is a very FinTwit love stock, right? Like that is not a hidden stock whatsoever. Everybody knew that IAC was spinning off Match. This was in 2020. It was announced. It was confirmed. It was confirmed many times. The distribution ratio had been set, and yet you could buy IAC. And if you backed out IAC's stake in Match, which you were going to receive, and its stake in Angie, the stub value, which at the time included Vimeo, Dotdash, and a bunch of other assets, was valued by the market at negative $1.5 billion. So it shouldn't have. You wouldn't think it would happen in an efficient market. But if you just pay attention to the spinoff transactions that have been announced, there's a ton to do. And then we haven't even talked about international names, which I'm not as close to. But there's also a lot of spinoff transactions internationally, which are arguably more interesting because they're, most people in the US are a little bit more familiar. They're a little bit easier to track from a spinoff perspective.
Got it. So then when these spinoffs are announced and you've identified them and there's a lot of work to do, what's some of the criteria that you look for in a quality spinoff?
Yeah. So, I've, my dad was a value investor. So I personally invested in Blockbuster back in the day. So I had to get rid of the value bug. And I think, one thing that I've definitely appreciated is that Generally, it's not a good idea to invest in a company that's in secular decline. I mean, that might seem totally obvious to everybody, but even if it's trading at a ridiculous cheap price, it's just generally it doesn't work out. It doesn't work out that well, especially if the company has a lot of debt. And so, what I try to do before a spinoff is announced is I try to, if I think, there's going to be some indiscriminate selling pressure, I'll try to do some work. I'll read through the Form 10. I'll try to understand the quality of the business, whether revenue's growing or declining, the margin profile of the business, how capital intensive it is, kind of basic questions, how competitive the industry is, what are the pure play comps, like what would this, if this were out for a couple of years or were IPO'd, how would it be valued? And then what I try to do is I try to come up with kind of a fair range of valuations, and hope the stock will trade at a big discount to my implied fair value. Fair value, it's just an estimate, so I like to have a big discount to that estimate. But you can invest. I found that you can invest in situations where it may look like a low growth or value asset, but it's not in secular decline. I'll give you an example. Kontoor Brands was a spinoff from VF Corp, and they make Wrangler and Lee jeans. So jeans, Wrangler and Lee weren't growing like crazy, but it's a pretty good brand. Jeans aren't going away anytime soon. Different styles come in and out of favor, but it's not, from my perspective, it wasn't an apparel line that's in secular decline. And so I was able to kind of get comfortable that this would probably be perceived as a bad asset and would sell off. And so, I was able to buy that one, cheap, and ultimately, sell it at a good profit. The other thing that I really look for is potential dividend initiation. So I know our friend Maj has coined the phrase info arbitrage. And I think this is kind of a perfect example where it's public. You can look it up, but nobody does it. And basically in these Form 10s, they will state oftentimes whether or not they have a dividend policy. And sometimes they'll even tell you how much they're going to pay out. And so in the case of Kontoor Brands, basically, they hadn't declared the dividend because it had to get spun off. And then the board had to officially, approve the dividend. But they said, hey, we're going to pay out, I forget what it was, 250 or 285 million as a dividend. And you could run the math, and it worked out to like an 8% yield. And then you could look at the other apparel companies, and I think Hanes brand Baby had a dividend yield, but all the other dividend yields were nowhere close to 8%. I mean, 8% was like a tobacco company yield. And so the nice thing about a dividend, I mean, it's pretty inefficient from a tax perspective, but the good thing is it forces the stock to re-rate really quickly. And then another example of this is Jackson Financial, which is, a name that I own again. But one thing that I was excited about was it looked incredibly cheap. It's in the annuity business. So annuities are not at all sexy, but they've been around for 250 years. People like annuities. I don't necessarily like annuities, but people actually like annuities. And I think they're going to be around for another 100 or 200 years. And so the business is not in secular decline. It looked, optically very cheap. And then in addition, it looked like they told us how much they were going to pay out in buybacks and dividends. They didn't say, they said, in total, it's going to be about 375 million between dividends and stock buybacks. They didn't tell us the dividend yield, but you could kind of read between the lines and look and interpret that they were going to initiate a dividend, which they did, and the stock has been off to the races. So those are some of the things, that I look for when I'm evaluating spinoff that might be a good opportunity.
So you said like one thing in terms of like what not to look for, but I mean, are there any red flags when you're evaluating some of these spinoffs other than just secular decline? Like what else is there, unscrupulous management? Come on, there must be some fun, hairy things that you find.
Yeah, totally. So let's see. So I'd say, I mean, these are all obvious, but like, high debt is, especially if the business is in secular decline, that's tough. That can be really tough. Another thing is just high rate of interest. So if the company is paying like 10 or 11% interest, and there are spinoffs that are paying that high interest, it just is insane to me. And it's been like 100% success rate that whenever I've had, a company with that high rate of interest, the stock has performed incredibly poorly, because it just goes to show you, how the creditors view the quality of the business. So that's one thing. And then conversely, if you have a business that is perceived to be a bad asset, but it has debt in the market trading at like 2% or 3%, then that's kind of reassuring, because it just reinforces that maybe this isn't as bad an asset as equity holders think, because bond guys and gals tend to be more concerned about the downside. So that's something that I definitely look for. In terms of other red flags, it's good for management to own a bunch of stock. But if it's a large cap company, odds are they're not gonna own a lot of stock. So that, that's one thing that I do look for in terms of alignment. I would say, I guess the other red flag that I've learned the hard way is just basically taking management's word for it. So oftentimes I'm not a sector specialist. So like I'm coming into a new industry and, I'm relying largely on guidance from management. And it's important to just sense check whether that actually makes sense, like with prior trends. Like if management is expecting a sharp turnaround in the business, like if the business has been declining, for the past 3 years, like how is it magically going to turn around? So I guess one other thing is kind of taking, using guidance, and that can be really helpful, but definitely not putting full faith in it, because, that can definitely get you into trouble as well.
Absolutely. Because I keep trying to think of like more myths, because I'm gonna ask you in a second about why it goes unnoticed. But like, do some people tend to think that, all right, companies spinning off that business or that division, is that seen as like, okay, well, this might just be a failure because they couldn't sell it? Like, why don't they just spin it off then? Is that something that goes through people's minds?
Totally. I mean, the other factor too, and this is a huge factor as to why companies spin off these assets instead of sell them. If they were to sell these divisions, oftentimes you have to pay a big tax bill, but most spinoffs are tax free. And so me as a shareholder, I would much prefer to actually just receive the shares myself, as opposed to the enterprise, having to pay 30% tax rate on the proceeds or something, especially if the basis on the business is incredibly low. But yeah, I mean, it's definitely, and sometimes I think the companies are trying to perceive bad assets or low growth assets or low valuation assets. But at the same time, like usually there's a price, right? That makes it fairly compelling, especially if you have a catalyst that's going to force the spin-off or the stock to re-rate. But I'd say, oftentimes, they are trying to get rid of a low quality perceived asset. I mean, you have other examples like Vimeo is a spinoff from IAC recently, and that one has not performed well. It still has really good fundamentals. I think IAC is kind of like a value stock, Twitter favorite stock. And so I think there's just like been a big turnover in the shareholder base in terms of Vimeo, and then growth definitely has decelerated too. But in that case, it was just a company that's a phenomenal company. And IAC's business model is to incubate these companies until they can stand on their own, and then spin them off. And that's what you want. IDT, I know that's a company that you're familiar with. They've spun off like 5 companies that have all, generally done pretty well. There's probably another couple in the pipeline for IDT. But, I'd say more oftentimes than not, the parent company is trying to spin off a low quality asset.
So you talked about a few case studies already, and even some very well-known examples, but what would you say are some of the most famous examples of not only just it was a well-known parent company and spun off a well-known subsidiary or something? Give us some of the most famous examples that are out there. Maybe one or two.
Yeah, of course. So one, I mean, this happened last year, and it's kind of an interesting case study, but United Technologies basically was a big conglomerate, right? They had the aerospace division, they had the elevator business, and they had the AC business, basically. So like a really well-run company, good capital allocation, but those businesses, they're all going to trade higher, on their own than they were together. So, and even though, that was the case, there was still an opportunity to buy that thing ahead of the breakup and make some really good money. Granted, the spinoff happened right as COVID was kind of at its worst, right when the market started to crash. So I think that definitely contributed as well. But RemainCo United, which ended up merging with Raytheon, is the remaining company, so a defense contractor plus aerospace. And then you have Carrier, which is really focused on kind of refrigeration and other stuff like that. And then you have Otis, which is just like one of the biggest elevator companies in the world. And that spinoff has worked out really well. Otis has done very well. Carrier has been a rocket ship, and then I think UTX has even recovered with the aerospace recovery.
All right, I don't want to dig in too much into your research or do create some premium content that your subscribers will be like, "What? You did that for free?" With my next question, but I mean, from what you see out there right now, I mean, we're seeing stocks continuing to reach all-time highs. These huge, massive companies becoming bigger and bigger. I mean, are there any from these bigger, FANG stocks or any of these other, $100 billion stocks that we could be seeing some spinoffs from, or I don't know. I'm just be curious.
Yeah, no, totally. I mean, I think so. This is going to be heretical, but I think like Berkshire Hathaway. I think if Berkshire Hathaway, once Buffett, hopefully it never happens, but once he passes away, there's probably going to be some discussion about whether or not to break up Berkshire Hathaway, and the stock would definitely trade at a premium. I mean, there would be a lot of value unlocked there. I don't want to go there. I know people don't want to talk about that, but that's one that interestingly.
How dare you?
Yeah, exactly.
How
could be
dare
interesting.
you?
I mean, I think Google, right? It's like Google. They have YouTube. I mean, I don't know what YouTube would be worth by itself. I mean, in this crazy meme environment, I don't know what Waymo, their EV autonomous driving unit would trade at. So, I mean, Amazon could spin off AWS. Like, they definitely could definitely unlock some value. And especially with all this pressure from the regulators on these tech perceived monopolies. Facebook, same thing. I mean, Instagram, what would that be worth? WhatsApp, what would that be worth? So I mean, I think if it were to happen, I think it would be a positive. Rockefeller's company famously had to be broken up, and it got spun off into Standard Oil of New York and Chevron and Texaco and all these companies. And I think I forget the exact returns, but once those companies were broken up, Rockefeller got a lot richer because all those individual companies were valued kind of as pure plays for different geographies around the country. And so it actually unlocked a lot of value. And I think a similar case definitely, could be said for all the big tech companies. There's a lot of value there that definitely isn't being probably fully appreciated if kind of on a case-by-case basis, looking at each individual division.
I mean, we haven't really seen too much. I mean, obviously it's talked about a lot, breaking up big tech and breaking up some of these other, huge conglomerates, but it's not, I can't remember a story in recent memory of the regulators actually saying, all right, let's go break it up. It's time, I can't remember anything recently, at least in the last couple of years.
I can't either. Yeah, it's more about, I guess, right now, the focus has probably been on like no acquisitions. Like, Facebook's not going to be able to make any meaningful acquisition probably for the rest of its life. But yeah, you're right. There hasn't been any focus on it. I mean, it'd be interesting to see if any of the companies initiated. I mean, I think that would be a massive. If you wanted to unlock a lot more value, I think it definitely would.
I wonder why they wouldn't. I mean, what do you think?
I don't know. I mean, for Bezos with Amazon, it's kind of like, it's his baby, it's his one, company. It's all under the same umbrella. He's worth however many $100 billion. What does he need another, $100 billion? Same thing with Zuckerberg. Maybe it's kind of like about, building his empire and, making it bigger and bigger and being able to be in control of all of that. But I don't know. That's just me, riffing. I have no idea. I have no idea in reality.
I figured we'd riff on it a little bit just because it's like, I mean, you make a very good case. And I mean, we know this a little bit going in, like, hey, especially if there's a ton of value to be unlocked, if you want to spin off some of these things, like,
especially if they're good assets, like really, high quality assets. Like it's not like they'd be spinning off dogs. Like if, Google spun off Waymo or YouTube,
Tesla,
I mean,
or even Tesla spun off SpaceX. I mean, like, can you imagine?
Yeah. Right.
I mean, does
Tesla own SpaceX, or I guess
they
Elon owns them all?
Elon's own, yeah, I guess Elon owns them all. Okay, all right. Tesla,
but that would
to come
crazy.
for me. Yeah. All right. Well, so one of your big Twitter threads that you posted not that long ago is about how spinoffs usually just go unnoticed by investors. So why is this the case?
Yeah, I mean, I think it's just like there's so much to do, right? Like you're busy, you got your business that you're running, like everybody else has their business that they're running. There's just so much to do, and there's so many of them, and they kind of sneak up on you. And even though people know that they're interesting opportunities, they often sneak up on you. I mean, even I miss some of them, and it's like it's my job to track them. And then I mean, the other thing is it's like you just got to do the work. Like they tend to be smaller end of the spectrum. So if you're mainly focused on big cap stocks, it's not going to be that relevant for you. And it's just hard to dig through the filings, and just something as simple as find the capitalization, like what's the right shares outstanding, what's the pro forma debt, what's the earnings profile of the business. I think it's something that just kind of takes a lot of work. And, unless it's your mandate, to look at it, I think you're probably just gonna you're probably just gonna miss the majority of them unless somebody flags it for you.
Very good. All right. So Rich, we're at my favorite question that I love to ask everybody on here. What would you say is an investing experience that changed your career the most? I'm assuming it was that first spinoff.
Yeah. So I know this question because I've listened to your podcast. So I kind of had thought about it. So it's a name that I might have talked about with Maj, but it's a name called Liberated Syndication, and they're a podcast hosting company. So you're probably familiar with them, but they basically, it was a microcap stock, but they basically were spun off from a company called Fab Universal, and Fab Universal had like a checkered past where the company basically went bankrupt because of fraud. Like they acquired a Chinese company. The Chinese company ended up turning up being a fraud. But the company didn't go bankrupt. All debts were repaid, and what was left was this little podcast hosting business. And so they could have just not spun it off and just started to turn around the business and just reemphasize that we still have this little business here. But what they did to kind of create some separation between Fab Universal and the new company was spin off Liberated Syndication. So if you own one share of Fab Universal, you got one share of the spinoff called Liberated Syndication. And I don't know how I stumbled upon it because they didn't file a Form 10. It was a microcap stock, but it looked like it was trading. It came out at like 20 cents. And I think it had generated like 20 cents of earnings the prior year. And it was growing, 20%, 25% organically. And it's in this podcasting business that's just completely blowing up. And so I did a ton of work, probably the most work that I'd ever done, and ended up buying that one and making a lot of money on it. But that was just really fun because it was I guess when I first started reading Greenblatt's books, I was too dialed in on like any spinoff is good, and you think like, oh, nobody's looking at this, but really like there are a lot of crappy businesses that are spun off. But this was the first situation where I was like, wow, this is actually like an incredibly attractive business trading at like a crazy valuation. And unless it's not a fraud, it's going to be a home run. And, I did some work to get some confidence that it wasn't a fraud. But that was the first spinoff that I made a ton of money on. And then it also really opened me up to the opportunity in microcaps. Like these situations exist. I mean, you don't come across them all the time, but you can find these incredible values that because of a cork in the system, nobody's looking at it. So I'd say that's probably the most my favorite kind of initial experience.
Very cool. Are you still a shareholder in Libsyn?
Good call. Yes. So I am. I actually sold it and then I bought it back. So it's kind of it's morphed over time, but yes, still a shareholder.
It's an interesting one. I think we talked about it a little bit on Maj's one. So yeah,
totally.
I have my opinions on it. For full disclosure, I'm not a shareholder, and I use Podbean. But again, it's a story for another day. Anyways,
yeah.
So, as we're coming a little bit to the close here, what would you say? What advice would you have for investors that may not have been looking at spinoffs before, but now want to maybe dip their toe a little bit and understand it a bit better?
Yeah. So I would say, read Joel Greenblatt's book. It's eye-opening. Read Seth Klarman's Margin of Safety, because he has a chapter on spinoffs too. And it's really expensive if you buy it on Amazon, but like there are PDF copies floating around. I have one if you want to message me and I can share it with you. But that's interesting. There's a lot of literature. There's a lot of sites, including mine, where I have a premium service, but I also put out a lot of, free content as well. I have a spinoff calendar, which, has most of the spinoffs linked. So you can kind of check out what are the upcoming spinoffs. But I would say, dip your toe in. I mean, I'm a big fan of keeping like an investing journal. I think the best thing to do is to start a blog, Substack. It's never been easier to start like a blog through Substack. But, just to kind of hold yourself accountable and document the decisions for why you're choosing to invest in any company, whether it's a spinoff or not. Because I feel like, I really didn't start learning that much about spinoffs until I started investing and also kind of wrote down why I was doing it. And you kind of start to have some pattern recognition about, what tends to work and what doesn't work. So I would say, there's a lot of good resources. The Greenblatt book's awesome. Bunch of good info on Twitter and online, and then just, dive right into it.
Very cool. Well, Rich, we're there, man. Where can our audience go and find more information to follow you on social media as well as subscribe to your newsletter? Yeah.
So stockspinoffinvesting.com. That's my site. So got a bunch of, free good stuff there. So check that out. You can also Google just stock spinoff investing and I should pop right up. And then I'm on Twitter at stock spinoffs with 2 S's. Stock spinoffs was taken. So I just added on an S. Probably not the most creative idea, but that's where you can probably learn the most about me and kind of interact about spinoffs.
Very cool. All right. Well, Rich, before I let you go, did we miss anything? Did we cover everything there is to cover on spinoffs?
Dude, this was comprehensive. We covered it all.
We did it. Okay.
Yeah.
All right, good. Spinoff Twitter's not going to come for me saying like, you should have talked about this. Are you sure?
I think you got it all, buddy.
All right, good stuff. Well, Rich, thank you so much for joining me today, man. I really do appreciate it. Good luck. Stay safe. I look forward to our next update.
Thanks so much, Bobby.
All right, see you again. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet Microcap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.